Good morning, everybody. Hopefully you had a great weekend and having a good start to the summer. We are going to do tape review a little bit later on for asset weighting, but we got a few things to cover before that. So let's hop in here. So last week's 5-minute moneymaker is here's a great acronym developed by creators of neuromarketing, and their take on the most important characteristics of persuasion: simplicity. Keep it simple. Do we try to keep it simple on 5Q? Do I like big words, or do I like when we're speaking with clients to simple words? Do we like to tell stories? I mean, look at our bond interest rate volatility. Do we try to make that complicated, or do we try to make that very simple for them to understand? And how about our FIA presentation? Do people understand? It's funny. The industry says FIAs are complicated. With our FIA explanation, how many people understand basically what's happening? How many clients understand basically what's happening with that FIA when we're done with that? When you're done with that presentation? Yeah. Perceived self-interest. Con men agree it's the key to getting us to do something. So they need to see why it's good for them. Well, we do that through open-ended questions. We let them not only do they perceive self-interest, they tell us they have self-interest. Incongruity, surprise people. So do we surprise people? What's the first thing we cover? When they come into our meetings, what do they think we're going to talk about? Money. Instead, what do we talk about instead? Survivor's Guide. They're like, holy cow, what's going on? This isn't what I'm used to. Or when they give us an objection, what's the first thing we say? Absolutely. So we surprise them constantly. Confidence, well, that's why we stress doing your 15-minute drill and doing the scripts. The more confident you are, the more they're going to believe in you. And empathy. Look people in the eye, nod when they nod, tell them that you view the world the same way that they do. We trust people that are like us. This is a great one. Why is our system built for empathy? See if anybody can get this. Why is our system more than anything about being empathetic or empathic? Why do they think we heard, why do they look at us being just like them? Because they're telling us what they want to do, and every time they tell us what they're thinking, what they want to do, we give them a little verbal pat on the back. So that tells them we're just like you. That's right, Nick, ape. They tell us we're just, by aping them, by agreeing, by parroting, by empowering them, it lets them know we're just like you. So all these things are rolled into it. It's a little bit different than what Cialdini's principles of influence are, but they all are rolled in there. So 5Q tape breakdown, great example of when and how to empower a client. A lot of guys want to know, how do I empower? Where's a good example of power? Where there's this 5Q breakdown from last week gave you an example of that. One of the things that people continually have questions about is, and again, some people never have this problem. Some people have it all the time, which is when people come in for a first meeting and then they say they want to move forward and then they don't move forward. How do you take care of that? Well, here's the thing. You got to figure out what keeps them up at night. What keeps them from sleeping? Well, these are the things that are going to be good hooks to get them to come back. So what are the big 3 buying emotions? Anybody have an idea? Buying emotions. What will cause people to buy things? What kind of emotions? Fear. Good, Nick. Fear, greed, and frustration. Cheryl, you got it. She got all 3 of them. Greed, fear, and frustration. Those are the big 3. So you always want to end your meetings. If you want people to come back to the next meeting, you always want to end your meetings with these 3 questions. We want to address greed. So why would this be a good thing to address? So is that an open-ended or closed-ended question? It's an open-ended. Because when I'm talking to guys and they say these people didn't come back to their next meeting, and I go and listen to the tape, guess what I hear at the end? The assumed close. What's wrong with the assumed close? Now, I was brought up on the assumed close. In the 1980s, that's how I was taught. When I came into in professional selling business, I was brought up on the assumed close. Assume the close, move forward, whip out that ticket, assume they're going to buy. We don't do that because things have changed in the last 30 years. We do not assume close. They need to tell us why this would be a good idea. And you guys, you should write this down. Write these 3 questions down, because if you do these 3 questions, people will come back to your next meeting. Always, 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 always. Have them tell you, why would this be a good thing to do? So whether it's, why would this be a good thing to go through the full checklist? Why would this be a good thing to address? Why would this be, why would you want to move forward with this? Why would you want that? Ask them that. They're going to explain why it's good to them. That's going to address the greed. Then we're going to address fear. What would happen if we didn't get this done? What would happen if we didn't get this done? What would happen if we didn't do these non-financial things and then one of those things happened? What would happen if we didn't get these fees lowered? It's a different take on greed. It's the polar opposite of that is fear. So write that down. What could happen if we didn't get this done? And then the last one is frustration. Why would it be? This is an important one. If we're trying to get them come back to do a 21 point checklist or a full checklist, you want to then ask them, so why would it be, why would it be worth going down to the basement and going through the filing cabinet, trying to find it? It's a beautiful day out. Why is it worth trudging down to the basement, going down, looking at the filing cabinet, grabbing looking through all the different folders to find the power of attorney, to get your statements put together? I get it. It's a pain in the butt. There's better things to do in summer. Why would it be worth doing that? So you're going to ask them, why would it be worth going through the frustration of looking for the documents, coming into a stuffy office again on a beautiful summer day, doing putsy, boring things like these? You want to lay out the frustration for them up front. Do you know why we want to do that? Well, what they found is that looking at doing MRIs on people's brains. So they broke, you've heard me talk about this with basketball, shooting free throws, but they did a study, and this has been done over and over and over again with pianos, or playing the piano. And what they found was that there was a group that did no piano, there was a group that did mental practice, and there was a group that did physical practice, actually practice on the piano. And then what they did is they took the MRI. And what are they finding out between people who actually practiced physically with their fingers on the piano and people who did mental practice? Could the brain tell the difference? So everybody answers this. Could the brain tell the difference? And we've talked about this with free throws and everything else. Can the brain tell the difference between actual practice and what's going on in their head? It can't. No. So here's the great thing. If we ask them these 3 questions, why would this be a good idea to do? And they tell us out loud in their own words, what could happen if they didn't get this done? And they tell us in their own words. And then we have them tell us, why would it be worth the frustration of trudging around or going to the bank and getting the power of attorney out of the safety deposit box, or going down to the dusty basement and pulling out the powers of attorney and putting these statements together? Why would it be worth coming back on a beautiful summer day? Don't we all have better things to do on summer days? Come back to my office and it's boring putzing. Why would you do this? Because if they visualize all of these things, they now what, guys? If they visualize all of these things, what are they now? What's happened? They've lived them in their brain. They've lived them in their brain, especially this frustration thing. Because really, the biggest reason people don't come back is they don't remember why it was so important to come in. Because we learned, what is a yes? When we do assume close and they say, yeah, I want to do this, what is that worth? Yes, I want to do this. What's that worth? Everybody answer this. At the end of that first meeting, if I say, do you want to move forward? And they say, yep. What's a yep worth? Nothing. Yeah, exactly. Everything, nothing. It's worth nothing. But when I have them tell me in their own words why they want to do this, what could happen, the consequences of what could happen if they didn't do it, and more importantly, walk them through the frustration phase of grabbing the documents. Because that's what happens when they get home. They're like, oh, crap, I don't want to go through the hassle of that. We have to have them live the hassle in their mind and find out the hassle wasn't that big a deal. So, Jeff, would you have anything to add to that?
The only thing that I would add is this is something that's talked about and written about. And there was a study just recently about diets. And they said that you boost the chances of a diet being successful by something crazy, like double it, like 100%, if you talk to people about, hey, what are you going to do if you start getting hungry late at night? Well, I'm not going to do anything. Yeah, but you're going to walk by the refrigerator and then what? I'm not going to open it. See, if they talk through it, they're 100% less likely to do it than if they don't. So if you can get them
That's a
talking through
great
these
example.
things, they're more likely to do them than not.
That's a fantastic example. So guys, this stuff does work. So write those 3 questions down. Did anybody not get those questions? Because I'll flash them back up. Otherwise, did everybody write them down? Good. Good. So Jerry wanted to bring up something that's going on here in the with the insurance companies. So Jerry, could you jump in here and give people the heads up?
Yeah, absolutely. Good morning, guys. So this is kind of a public service announcement, really, and I've told a lot of you guys kind of a good rule of thumb. We'll kind of say this. A lot of times when it comes to our applications and doing the work to bring clients on and taking those apps and bringing them on, the less mistakes and problems that happen, especially when it comes with paperwork or having to go back and visit with a client multiple times, we want to try and avoid those things as much as we possibly can. And so I just wanted to give everybody kind of a tip to be able to cut down probably a massive amount of mistakes that can happen out there. We haven't had it happen very often, but if it happens a handful of times, that's too many for me, and I think for anybody that has to go back multiple times, they can agree that if there's a way to avoid that, they'd say, yeah, I want to be able to avoid that. So kind of a rule of thumb that I've had out there and I've reminded a lot of people, and it's good that we bring it up, is application. So the carriers, they're changing the disclosures, the statements of understandings, various things in those applications more rapidly now than they ever have in the past. So when that happens and then those disclosures come in, they're old, you're going to have to end up go back and get that disclosure signed, and that's not fun. So here's how we can avoid those things. What I've said in the past was if an application is ever more than a month old, get a new application. Here's what I would say now is if it is over a month old, you can get a new one, or you can call in and ask and find out if there's been a recent change to it. But what I think is the best way to go forward right now is if you get an application and you're not going to take that app and then get it sent in within about a 14-day, 2-week period, if it, a lot of times you plan on doing it and then something ends up, delaying that meeting a little further out, I would suggest if it's going to go further than 2 weeks, get a new application or just give us a call and we can check to see if there's been a change made. Right now, there's so many changes that are made with the applications. A lot of times the carriers won't even let us know if they've made that change. And the reason why I say 2 weeks is they'll generally, even when they make a change to the form, they'll give it could be anywhere from a 14-day to a 21-day grace period before they won't before they'll not allow that old form to be used. And so there is a grace period that's there, but the reason I say the 14 days is because typically that grace period is about 14 days. So I've seen it happen a handful of times in the past where an application was pulled, let's say, on the last day of a month. It could be the 30th. They end up changing the form on the 1st or the 2nd, and then all of a sudden, you're into that grace period already. So it's important just to, we want to keep that down to about a 14-day period if you can. If your app is 21 or 30 days old, it doesn't mean something's been, going to change with it, but I want to try and avoid those problems. So if it's going to be longer than 14 days, call and check. We'll make sure the app is still up to date, and I think we can avoid those problems. And then also on that note too as well, sometimes, I get it, the paperwork, it's cumbersome sometimes. We'll take an app and then I'll have guys, they'll sit on it, client signatures on it to fill it out, and they'll sit on it for like a week or two even before they'll send it in. I would recommend not doing that because you could end up, you have a good app, everything's filled out, and then because you sat on it for a while, all of a sudden now there's a disclosure that has to be re-signed, and you end up having to go back to the client. So just wanted to give that notice. Apps more than 14 days old, get a new one, Another thing you could do too as well is, hey, if you know you're not going to be taking the business, don't get the app so early. If you need to fill it out and you want to do that, I get that. We'll get it out to you, and then you can just check to make sure it's up to date. Or if hey, I'm going to be taking the app on Friday, give me a call and say, on Wednesday, ask me to send you the app unless you need it a little bit sooner. But just wanted to give you guys that notice. Old apps, don't want to use it. Keep it to about that 2-week period of requesting apps prior to taking an application. Thanks, Mike.
Jerry. Yep. That way it makes everything easy for everybody. So for today's tape review, we're going to listen to an asset weighting. So I tell guys we want to see a 50-50 between guaranteed and growth. And the guaranteed goes in the FIA because FIAs beat the crap out of bonds. Why? Because I say so? No. How about Roger Ibbotson? He says so. How about the numbers? They say so. How about the fact that we're at a 100-year low for interest rates and the only way bonds are going to go is down? So there's a great reason for that. So when I say you need to go 50-50, 50-50, does that mean because I'm saying it? No. Does it mean because you're saying it? No. Who will tell us that? Who will tell us that they want more than 50% of their money in growth? Yeah, the prospect will. If you ever send me a tape where you do the script right, if you ever send me a tape and you do the script right and the client wants all their money in stocks, guess what I'm saying? God bless them, it's their money. But in 65,000 plus tapes, guess how many times people have said they want more than half of their money in growth when they do it right? 0. That's pretty impressive. 65,000, 18 years. Nobody has done it when you do it right. So, and we're using a lot of psychology in there to help them realize what's really important. So, this is the crib notes for investment weighting. First thing we need to do is get them to say what's the difference between market sensitive and preservation, so they understand what's going on there. Then we're going to have them describe how a bell curves work. Now, this is a great lesson for bell curves, for our system as a whole. Anytime we're going to get them to commit to something, do we go right to their particular situation, or do we talk about, I always say third party, that's not really the right term, but more general type examples? Very good, Till, thank you. Till's got it, general terms. So anytime we want to talk about, have them to commit to something, we don't go right to their particular situation, but it still says we go to general terms. So for the bell curve, we're going to use a race, a bunch of people running a race for a bell curve. That's so they can say, hey, that's how a bell curve works in real life. So then when it applies to them, they understand that that's the way it works for their particular situation. Then we're going to ask them, where are you on the bell curve? This is where you get them to lock in that they don't want to be way, way, way aggressive. If you do this bell curve right, where are they on the bell curve? That's where you're going to get them to say that they don't want to be aggressive. Then they're going to tell us what their numbers are. Then we're going to talk about the formula, 120 minus age, 110 minus age, 100 minus age. Then we're going to talk about why those numbers, work that way between a 5-year-old and a 95-year-old. And then we're going to talk about being wild and crazy and a stick in the mud, which is, again, referring right back to number 3, where they're on the bell curve. Going to say where are they with the formula. And we talk about flipping a coin. The flipping the coin is about you already have a comfortable retirement. And I said, hey, if we flip this coin, and I want you guys to answer this. If we flip this coin, if you got a comfortable retirement, I say, listen, here's the deal. We'll flip this coin, and if you call it right, you get twice as much as you already have. If you call it wrong, your comfortable retirement goes down the drain. How many of you will take that bet? Yeah, turn number 2, right? Let's make a deal. Exactly, Mike. And Dale, Nick, it's talking about, I'm sorry, Till's got it. Yeah, let's make a deal. How many people will give that up? Nobody. And again, we're working with people that have achieved a comfortable retirement. Well, and, it's even worse. If I'm near where I want to be, maybe I don't have quite the comfortable retirement that I want, but at least I'm surviving. Will I take that bet? No way. Then it's even worse, right? The only person who's going to take that bet is somebody who has nothing to lose. And who has nothing to, when it comes to retirement, who has nothing to lose? Who's the person that has nothing to lose? Do you want any of those people as clients? The people who have nothing to lose? No, it's people who have no money. It's right, they're broke. They're broke. So let's go ahead and listen to this tape, and let me bring it up here.
next thing on here. And there's only just a few more things on here. I know it's been.
But it's hard.
You don't want some more water?
No, thank you.
Okay, and we don't have to cover all of it, but asset weighting is important, and that's just.
Can I just bring that up? I want you to hear that again. We got to make it bigger here just a second. Let's see what I'm doing.
Asset weighting is the next thing on here, and there's only just a few more things on here. I know it's been.
But it's hard.
You don't want some more water?
No, thank you.
Okay, and we don't have to cover all of it, but asset weighting is.
Guys, what is he telling the client right there? Let me see if you guys can catch this. What he's telling the client. That's what I think, Till. Till said waste of time. That's what I think he's telling him. Yeah, there's a lot of stuff here, whatever. We don't have to cover all of it. It's not that important. Yeah, nothing important, exactly. So, no. First of all, if they get tired, what do you think's happening if they get tired? Because I've seen little old ladies after 3 years, I hope not 3 years, 3 hours of meeting, 3.5 hours of meeting, they're as pumped up as they've ever been in their entire life. So what's it tell you if they're tired? Not enough engagement, yeah? Well, what kind of engagement? Not enough guts, Mike, you got it. Not enough guts. Not enough patting them on the back, telling them that they're brilliant, telling them that they're above average. That's what does it. Also, it tells that, guys, you can't all be, nor should you all be like me, okay? So, but just using me as an example, do I always talk at the same speed? Do I always talk at the same speed? Do I always talk at the same volume? Do I punctuate with punctuate things and get excited and then calm down, and then you want to be all over the, when somebody's telling a story. I just tried to get one of those audio, somebody recommended an audio on tape, or book on tape. My God, I fell asleep after 10 minutes because the guy was reading it like this, and that's not how you should read it. And we're all so afraid as advisors that we need to be professional. We need to be professional. I need to be serious. And guys, if you're serious for 2 hours, guess what's going to happen to them? They're going to fall asleep. They're going to be tired. Now, if they do get bored, I'm not going to tell them what he said, which is, I'm going to go back and play it again.
And there's only just a few more things on here. I know it's been.
But it's hard.
You don't want some more water?
No, thank you.
Okay, so what do I tell you? Anytime we hit some resistance, and would you say there's a little resistance here when she says, I'm tired, and he's noticed it. Good job to him. Kudos to him. He's noticed they're getting tired or getting bored or whatever it may be, rolling their eyes. What do you do anytime you get into a situation where the meeting's not going well, a little bit of rough spot? What are you going to do? I always apologize. I apologize. I'm sorry. This is a lot of information, isn't it? When it comes to your money, coming to health, when I go to the doctor, I get it. This is just so much information. You're tired. You're a little bit overwhelmed. Totally makes sense. When I go to the doctor and it's a big surgery, do you think I want more information or less information? No, I think I'd want more. Yeah, and when it comes to certain things, health, money, do we want all the information or we want some of the information? I would hope all of it. Yeah, so, if you don't want to go through all the rest of the information, if you don't want to know exactly what's happening with your money, we can stop, we can skip all this. Or do you think it would make more sense for when it comes to your livelihood to know exactly what's happening? No, you're right. No, exactly. It's just getting a little bit tired, but no, you're right. I need to hear. And I'll do that. You need to do that. You need to call them out. They need to tell you. See, he's apologizing, but is he apologizing in a manner that it's getting them to tell him why they need to move forward? Or is he apologizing, trying to run away from the fact that they're tired and bored as quickly as he can? We both apologize. I apologize. He apologized. But I've circled back and then wanted them to tell me exactly why they wanted to move forward and learn all this stuff. He apologized and said, we don't have to cover all this stuff. He's running away from it. If you start to run away from a problem, guess what's going to happen to that problem? You start to run away from a problem, what's going to happen to that problem? Go away? Yeah, it's going to get bigger, Cheryl. That's right, Scott. It's going to get bigger. So let's go. So that's not really anything to do with investment weighting. But first of all, it's telling you, dude, you better become a little bit more animated instead of trying to be so professional. Second of all, if they bring that up, apologize, but then circle back. Tell them they're right for being tired. Tell them they're right for being bored. But circle back and have them tell you why they want to learn this information anyways. Okay. So I'm going to start again, and then we'll get into actually the asset weighting.
Asset weighting is the next thing on here, and there's only just a few more things on here. I know it's been.
But it's hard.
You don't want some more water?
No, thank you.
Okay, and we don't have to cover all of it, but asset weighting is important, and that's just a fancy way of saying how much money you have in growth versus how much you have in things that are guaranteed. Okay, so the words we use for that are principal preservation and market sensitive. So principal preservation,
guys, I use this whole fancy schmancy terms a lot. Why do I do that? Why did I take CFP off my card, my business card? Why do I, when I present, do I not spend any time introducing me and when I'm presenting to a workshop or a seminar? I never talk about to prospects. I never talk about my levels of professionalism, all that kind of stuff. Nobody cares. It's about them. That's right. But also, the thing is that I want them to think that I'm trying to be smarter than them, or that I'm rolling my eyes at the industry and how they like to use their fancy schmancy terms, and I'm on their side of the table. See, but by rolling my eyes at the terms that they're using, I get right on their side of the table. I'm not trying to lord it over them. I listen to way too many tapes, and Jeff, maybe you can pop in here. Do you hear occasionally guys that are not using the scripts, and do they talk simple and plain spoken, or do they like to use their fancy schmancy terms?
No, they're trying to talk above the client. I think they're trying to show how professional and smart they are.
Guys, do you think does that work is that what they found works for people, Jeff? The science? No,
actually, and if you've been out to the training, you've heard me talk about the fact that attorneys are a lot like us in that the fact that they can't make presentations. They have to ask witnesses questions, and by their answers tell a story that the jury has to determine who to believe. When they went and kind of determined, what they found is that litigation is really complex these days. So imagine a plane crashes. Well, somebody's going to say it was the airline's fault, and the airline's going to say, no, it wasn't our fault, it was the weather. Well, both sides are going to call experts. And so what attorneys wanted to know is, how do jurors know which expert to believe? Because it can be, really complicated. And what they found is, what the attorneys thought initially going in is that people believe the expert who has the best credentials, the one who sounds the smartest, who went to the best school, who has the best degree. And it turns out it's not that at all. Jurors believe the person that can put it in layman's terms. Whoever can make it simple and easy to understand, that's who they believe. If it's too complicated, they just shut down and decide, nah, this can't be right.
And they actually resent the person using complicated terms. And that's why, guys, when you're not in my script, anytime we use correlation, do we lord that over them, or do we apologize for the fact that it's a fancy smashy term? So anytime we have to use a fancy word because it's there on the paper, we'll apologize for that word. But when I listen to guys that when they fall off the wagon and they start to use their own scripts instead of ours, guess which way their scripts always go towards? The complicated or simple language? It always goes to the technical, more complicated language. Don't do that, okay?
I think that stands for growth or guarantees? Guarantees. Yeah, it's guarantees, and then market sensitive then would be volatile. Yeah, volatile. That's right. And do you think we should have all of it in one or the other, or maybe some?
Well, I got 50-50, so.
Well, this
depends on how you look at the market and everything. Yeah.
You're right. 50-50 is a good way to go. That's
Okay, so what happened there, guys? This was a big mistake. So let me play it back again.
Right. And do you think we should have all of it in one or the other, or maybe some?
Well, I got 50-50, so. It depends on how you look at the market.
So did the guy give us a good answer? He said 50-50. Did the guy give us a good answer? Well, you hit it, Mike. But is implied. He corrected him. My God. If he gives you a good answer, don't correct him. What do we do when somebody does our work for us? Which one of the apes do we use? When somebody does empower, right? Empower. Tell him he's above average. He's done all the work for us. In fact, at that point, could we even skip the rest of this? We could. We don't want to because we want to lock that in. But he's already done the work for us. Don't correct him. So not only did we not only did we ignore the fact that he's doing our work for us, we're actually arguing with him about that. Don't do that. Don't do that. Did everybody hear it? If anybody didn't hear it, I'll play it again. So everybody hear that, or say no if anybody didn't hear what just happened there? Okay, so everybody got it. There we go.
And everything, yeah.
You're right, 50-50 is a good way to go. That's having a combination of the two is really good. You know, I have yours at 100% volatile because the bonds, are they guaranteed safe or are they?
Well, they're relatively safe, yeah, but no, they're not totally safe. The value is going to go down if interest goes up. But
Yeah, they are safer than stocks, but
yeah,
they can fluctuate, right? And if you hold them till maturity, then you don't have to worry about it because they pay back the interest. But since it's a bond fund, we're kind of at the mercy of what the fund manager does.
So since now you got a hint, they've already covered interest rate volatility. What does it tell you about? Did he lock that guy in on the fact that bond funds are about as dangerous as you can get when it comes to where your money is, especially in low interest rate environments? Everybody's saying no. So what do we need to do? So instead of I'm going to circle back then, because remember all the scripts are built on one another. If he's building a skyscraper, the floor that is interest rate volatility is solid or rickety or dangerous. It's rickety. I got to go back and shore up that shore because it tells me this guy does not believe. Yeah, he gets it when bonds go up. When interest rates go up, bonds go down. But that's fine. I'm going to hold the maturity. But he's got all of his money in bond funds. Does it matter? If you hold on, if you have a bond fund and you hold on, is that going to help you or hurt you? Are you being rewarded for being smart or being punished for being smart and holding on if you're in a bond fund? You get hurt and hurt bad. If you don't understand that, you need to go back and listen to because the fact is that if everybody else is bailing because their bonds are going down, what's that mutual fund manager required to do? Tell them no, you can't. You can't pull money out. They have to sell. So if you're the smart and you hold on, you're being punished as more and more people bail out of that fund and you know what? When they bail out, is there any maturity? Is there any maturity to a bond fund? No. So you are locked in. You are locked in to those losses. You will never, ever, ever get those back. And does this guy get that? Nope. Now remember, now the advisor is going to tell him it. And is telling, preaching, and teaching. If he doesn't believe it, is telling him it going to work at all? If you go back and tell him how it works, he's already said, I don't believe you about this whole bond fund stuff. Is telling him it going to work? No.
And if you hold them till maturity, then you don't have to worry about it because they pay back the interest. But since it's a bond fund, we're kind of at the mercy of what the fund manager does, right? And if they went down 20%, do you think there's some people in that fund that might say that's it?
Aha! So now he realizes what? I didn't do a good job with bond funds. I need to circle back. Is he doing the right thing? Yes.
probably. So
yeah. And, say that's it. That's all I can take, and want to get their money out of it.
probably. So
Okay, what did that guy just say there? What word? What did the client say? Probably, Mike. Do we like the word probably? No. Right, Charles? No. I'm listening for qualified language. I'm listening for them to say probably, or I see what you're saying, or could be, sometimes. No qualifying language allowed. Somebody say, yeah, probably. Because we think about it, if somebody, do you think if I had lined up 100 people in the room and we lost 20%, 100% of the people would be okay with losing that 20%? No. What would some people do? Well, they would bail. Okay, they'd bail, exactly. So we have a bond fund, and when they go down 20%, what are some people going to do? No, they're going to bail. I'm going to make them say it. They got to say it, got to say it. So let's see if he makes them say it or he lets what he does there. I'm backing up a few seconds.
Say that's it, that's all I can take, and want to get their money out of it?
Probably. So,
Yeah. And if some people do that, what's the manager got to do to raise the cash to cash them out?
So did he make him say it, or did he let that lay? You let it lay. Can't do that. Because now this guy, we don't know if he's on board or not on board. In his head, see, I want to read their minds. And right now, I don't know if he's believing me or not believing me, because I didn't circle back and make him give me a real answer.
You're going to have to sell some what?
some bonds.
Some bonds, yeah. And he's going to take a bath on them, and everybody that's in the fund is going to kind of share in that. So you don't really have stuff to him, you know. And we got to assume he's at least as smart as we are, or smarter. He's managing that fund, right?
Let's hope so.
So if we know that he shouldn't sell them until they mature.
Now, she's on his side. Is he complimenting her? She said two things now, and she's on his side. Did he compliment her either time? No. So if one of the spouses is helping you, you got to let them know what? Keep it up. And how do you let them know to keep it up? Ape them. Get on their side. Parrot what they say. Give them little pats on the back. And he missed both chances. So he's basically discounting the person trying to help him and going right after the husband.
Chances are he knows that too. But if he's got to cash somebody out, does he have a choice, or does he just got to do it? Yeah. Well.
So if the mutual fund manager people want money out, does he have a choice, or just have to do it? What'd the guy say? He asked an open-ended question. Mm-hmm. Uh-huh. So what's uh-huh mean? Uh-huh means I don't agree with anything that you're saying, but I don't really feel like I have the energy to argue with you. So now where is the advisor when it comes? Has he got the client to say bond funds are extremely dangerous in low interest rate environments when interest rates are going up? Has he got the client to say that? No. So he hasn't fixed that floor, but we'll see if he continues on anyways.
Yeah. Well, with this waiting, it's kind of like.
So what did he do?
I'll use a bell curve.
What did he do? He gave up. Guys, I get that it's hard. But he just now, what is anything to do with the asset weighting? Is the whole asset weighting script right down the tubes now, because he still thinks bonds are what? Guaranteed. So anything he comes up with asset weighting, is it going to help him? Because does the client really understand how bond funds work at this point? No. So they're classifying bond funds as what? Guaranteed. That's going to screw up his whole asset weighting script. So I know that it's hard, but you got to stick with until the client says what you want. Do you move on to the next part of the script? If you do not hear what the client needs to say in their own words, not a yes, not a no, not a uh-huh, but in their own words, do you move on to the next part of the script? No, no, no. Right, Scott?
Talk about that. Y'all familiar with the bell curve?
I think I have seen that before, yeah.
You know, it applies to a lot of things in life. If we have 100 people that are going to run a marathon, how many people finish right at the front of the marathon?
They're huge.
Yeah, it's just a few, right? And then at the end, when everybody's packing up and leaving, there's a few stragglers that are coming in too. But most people are going to be right where?
In the middle.
Yep, right in the middle. It's kind of the same with investing. You know, there's about 10% of the people.
So when the script is going right, is the guy doing a great job of aping? Yeah. But we can't just be good when everything's going right. We have to be good when they're fighting us too. So he's doing a great job. So this guy has the skills. He has the skills to do it right, but he panics when things don't go right. And why do we panic when things don't go right? Why do firemen not panic when there's a fire? Why do firemen not panic when there's a fire? practice, drill. If you only know this stuff well enough to get it right, you can panic. And then run away from things you need to do. So what you need to do is learn these things till you get them right, or learn them till you what? Can't get them wrong. Exactly, Dave. Can't get them right, Cheryl.
People who are just real aggressive, they're just wild and crazy. They're going to take all their Social Security check and go buy lottery tickets or bet it on rich, try to strike it rich, right? Then there's about 10% over here that are so conservative, they're going to take all theirs and
you're going to back it up
bury it
here.
under a big rock or put it in the bank, making 0.5% interest.
Mm-hmm.
Or bet it on rich, try to strike it rich, right?
Check. Go back further.
It's kind of the same with investing. You know, there's about 10% of the people who are just real aggressive. They're just wild and crazy. They're going to take all their Social Security check and go buy lottery tickets or bet it on rich, try to strike it rich, right? Then there's about 10% over here.
So the guy said try to strike it rich. Did he ape him on that? That's exactly what we want him to say. Did the advisor get on his side about that? Because the guy gave him exactly what he wanted. He didn't even acknowledge him. Guys, when they tell us what we want them to say, you gotta get way on their side, and he ignored it. So we'll see how that rears the.
That are so conservative, they're going to take all theirs and bury it under a big rock or put it in the bank, making 0.5% interest.
Mm-hmm.
But most people fall right in the middle.
So is he asking open-ended questions, or is he telling, selling, preaching, and teaching? He's telling, selling, preaching, and teaching, right, Cheryl?
That's where you think you would fit.
Well, I'm in the middle.
Yeah, I mean,
He said, I'm in the middle. That's good.
pretty much everybody I work with is. And so.
And he did a good thing there. He said, yeah, you're pretty much in the middle, pretty much like everybody that I work with. That's, that people like to be part of the smart group, and he's saying he's part of the smart group. So this guy is doing a lot right. But do you see how the little things he's not doing right can bite him? So here we go.
Looking at this combination of growth and guarantees, it's hard to say. I mean, we can't say what's exactly right for somebody because it's going to be the same for everybody. It's going to be different for everybody.
It's different for everybody.
Yeah, and it's kind of a curve, so we don't know really where on there you fall. But we do have some guidelines here that kind of give us an idea. And some economists from NYU and from the University of Chicago came up with these guidelines. And what they said is if you're an aggressive investor, you should have about 120 minus your age in market-sensitive things, those things that are volatile, right?
Mm-hmm.
So 120 and just averaging y'all's age, you got 65, is that about right? So 120 minus 65 is how much?
55.
Yeah, 55. And they say if you're a conservative investor, you should have about 100 minus your age in market sensitive. So I'm not saying
Market sensitive, is that you talking about stocks and bonds, or is that bonds?
no, that's stocks and bonds.
Okay.
Things that are, even though bonds are safer than stocks, they don't offer a guarantee on them.
Right.
They're, so they're still sensitive to interest rates or things like that.
Guys, when somebody asks us a question, should we give them the answer? We give them a short answer, but then we need to have them repeat that answer back to us in their own words, or do we know whether they agree with us or not? Yep, you're right. The bond monster raised its ugly head yet again. This guy is not on board with bonds being at risk. In fact, he was accusatory. You're just talking about bonds now. You're saying bonds are not safe. Is that what you're saying? No. Stocks and bonds. Now, why would we? Then I would have followed up and said, now why? So you always have to answer. Don't answer their question with a question. Bad. But what I do is answer their question with a quick, short answer, and then follow up with an open-ended question. So if he said, we're just talking about bonds here. No, you bring up a great point. No, stocks and bonds. And why do we include both stocks and bonds? That's how I would have done it, to get him to say both stocks and bonds are part of the market sensitive. But he didn't do that. He just tells them. We never want to just answer the question straight out and leave it there because we don't know whether they're agreeing with us or not.
So sensitive to.
Well, can I ask you guys a question? When they ask us a question, if we just answer it, why is that a bad thing? See, when they ask a question, in fact, for this particular guy, do you have any clue why he was asking that question? He was trying to see if this advisor had an agenda. He wanted to know if they had an agenda. Yes, Bonnie. He wanted to know what the advisor was thinking. And so, are you still on this kick about bonds? That's what he wanted to know, if the advisor was driving at. So you got to be careful. I need to let them answer for me, because if I just answer and don't take their temperature by asking an open-ended question, I may be just locking in their beliefs that I have an agenda. Do you get that? If I answer their question and don't ask them open-ended question, they may have asked that question to see if I have an agenda. And if I don't ask an open-ended question, I won't know whether I've taken care of that or not. See, do you guys, have you ever, everybody answers, have you ever asked a question to see where somebody sits on an issue? Have you ever asked a question to see where somebody sits on an issue? Scott says, Tom says yes. Charles says yes. Frank says yes. Yes. So they could be asking a question to see where you are on an issue, whether you have an agenda. If you just answer the question, that can be a problem. Tom said yeah, and Keith said yeah. So good.
Or things like that. So they're saying it'd be a good idea to be between 55 and 35. It's not an exact number, but your bonds are figured in that. And really, before we can really draw any conclusions from that, we got to look at how they came up with this, see if it makes any sense, right? And what they said was investors are worried about two things. You got inflation, because over time, what's going to happen to the price of things?
Oh, they're always going up.
It always goes up. And so if your investment's not keeping up with that, what happens to your lifestyle?
Yeah.
It'll go down. So there's inflation, and then there's losses. I mean, how do losses affect your lifestyle?
Oh, yeah.
Not too good, huh? So if we take two drastically different people, let's take a 5-year-old and a 95-year-old, and we'll use a bell curve again. A 5-year-old, do they pay any of their bills, or do their parents pay for everything?
Yeah.
Yeah. So if their parents are paying for everything, let's say the 5-year-old has money invested in the market. Sometimes the market goes down a lot, and it takes 2 or 3 years to come back. But if the 5-year-old doesn't need to spend any of that money, are they worried about that? No, they're worried about what things are going to cost in 15 or 20 years, right? I mean, they're probably not worried about anything, but if they were going to worry about something, they're worried all about inflation, what college is going to cost, or what car is going to cost.
You asking questions or telling, selling, preaching, teaching?
Going to cost. But the 95-year-old, do they care at all what things are going to cost in 20 years? No. They probably don't even buy green bananas, right? They're just worried about making sure they don't take any losses. You know, but we're not 5 and we're not 95. We're in the middle.
Can I ask you a question? Remember we started this whole conversation with the lady saying she was tired? Where is this guy? No, was that? Yeah, I thought it was him laughing at his own joke, but it actually was the client and the woman laughing at a joke, and it's probably just the audio. But remember, when we started, they said she was tired. Do you understand why they're tired? Where's this guy's range for speed, for delivery, for volume, for animation? He's what? Would you classify him more as animated or monotone? If you're going to put him on a curve, more it's monotone. It's you gotta punch. You gotta get have some fun. Have some fun, okay?
So that's what they're saying is we're not worried just about one or the other. We're worried about a little bit of both. And every year, as we get a year older.
Okay, so did he tell them how they came up with the number, or did they tell him how NYU and He did, exactly. And we can't do that. That's an important part. They need to tell you. Now, again, he's getting by with this because they've already decided they want 50-50. But if these people were in 80% growth, he'd be having a real problem right now.
And we move closer to this side, we're going to be more and more worried about not taking the losses, which is what you've been doing. That's why you've got half of it conservative, which is a great thing to do. And so if you were going to pick a number for yourself, 50-50s would that be what you would?
Yeah, that's what I think I got, yeah.
Okay.
Yeah.
That's perfect. I think that's a good number. So if you put yourself in a category, 50-50 would be more towards the aggressive, right? Given their formula.
Yeah.
But we'll just put 50-50, that would be.
Did he really need to do that, guys? No. In fact, by doing it, what did he just do? Getting on their side or getting a little confrontational? I know he doesn't mean to he's a very nice guy, but is he getting a little confrontational there? Now, I know you're a 50-50, but you're a little bit more to the aggressive side. And do you think that's going over well with this client? So listen again.
More towards the aggressive, right?
Let me back it up further.
So if you put yourself in a category, 50-50 would be more towards the aggressive, right? Given their formula.
Yeah.
But we'll just put 50-50, that would be what you're comfortable with. I think that's a really good way to go there.
Okay.
So if he thinks it's a good way to go, why did he bring it up? don't. And again, he was mortified when we listened to the tape, because did he realize he was doing that? No. But that's the importance of listening to tapes. You catch yourself doing these little things. He's a very nice guy, but perception is reality. And these people, that guy, what do you think? The guy perceived that he was correcting him, calling him out, or that he was getting truly on his side? No, he felt that he was correcting him. And I think that the advisor realized that, and that's why he quickly cowed and said, but what you're doing is a good thing, though. That we don't want to get in that situation.
The reason I put that down is if you guys want to come back and look at a solution or something that would give you the guarantee not to lose the money, but still get some growth potential, that would just tell us how much you would want to allocate to something like that. And really, guys, there's a couple more things.
Okay, so he could stop right there, but what he'd want to do is write 50% on the page, which we'll talk about in a second. If people have more money than 50% or want more or have much more heavily weighted towards stocks, we need to then go through the flip the coin analogy, which we talked about, which is you want to trade away everything you have right now for the chance of having twice as much as what you have right now, or do you want to make sure that that you could never lose what you have? Remember, that's the flip the coin conversation. He doesn't need it with these folks, so moving on is just fine. But if they're more heavily weighted in stocks, that's what you want. You want to make sure that they tell you, do you really want? If I had a coin, we could flip it. We could flip it, and so if you call it right, you get twice as much as what you already have. You get 2 houses, twice as much vacation, twice as much cars. But on the other hand, if you miscall it, you lose the comfortable retirement you have now. How many people we ask that question to are going to say, I'll go ahead and take the coin flip? None, exactly, none. So you do that if you need it. And then you're going to write that up there, and you're going to circle. Whatever that number is, write it on this page, circle it. And you're going to use that when we get to the implementation stage on the 3rd meeting. Yep. And then what you're going to ask is why. Why is 50% a good number? Have them tell you in their own words why that's a good number. Make sense? So when you mastered the crib notes and motive, when you mastered that daily practice of 50-minute drills, doing your 5-minute money maker breakdowns, that's when you're going to get every client to move to you. So thanks, guys. And then next week is 4th of July week. We're going to take a break. I know a lot of you are going to do it regardless of what I say anyways, but we will not have a coaching call next Monday. So enjoy your holiday week, and then we'll hit it the Monday afterwards. Thanks for being on the call, guys. Hopefully you got something out of it. And thank you, Marty. And you guys have a wonderful holiday week. Be safe, have fun, and we'll talk to you in a couple weeks. Thanks, everybody.